welcome everyone to the 16th Macro Finance Workshop, the first ever completely virtual Macro Finance Workshop, although it is technically hosted by the University of Chicago, as was planned originally, and the Becker Friedman Institute. And the workshop has been organized by Wenchen Du, Niels Gormsen, and Mike Chernoff, and from here on, they will be in charge, and I'm looking forward to the great program that they all put together. And please, of course, follow us on Facebook and Twitter. We're live streaming this event on Facebook, and we'll also be on YouTube, our own YouTube channel later on. And again, welcome everyone. Niels, the floor is yours, I think.
Yeah, thank you very much for coming, everybody. We've been looking forward to this for some time now. We have a program that we think is very interesting. Of course, it has we have 5 regular presentations, and we have a keynote address, and we will have then the online equivalent of a PhD poster session. The talks will have the format that we have a 20-minute presentation followed by a 20-minute discussion, and then 10 minutes of general Q&A in the end. If you have any questions during the talk, you can just type them in the chat to the right, and then the co-authors can respond to these questions in real time. For the last 10-minute Q&A session, we will go through some of the questions or some of the debate that has been in the chat. And we will also take questions from people who use the raise their hand button to indicate that they have a question. So with that said, I'll just give the floor to Nicolas Cousset, who will be presenting the first paper of today, which is called "Can the Cure Kill the Patient? Corporate Credit Interventions and Debt Overhang."
All right, so can everybody see my slides?
Yeah.
Yes. Cool. Thanks a lot, Niels, and thanks for the organizers for putting the paper on the program. So this is a joint work with Fabrice, who's also in the audience here. So the starting point for this paper is the fact that the ongoing pandemic and the recession it triggered have led to increased corporate default risk. So that's nothing new per se. That tends to be a hallmark of most recessions. What's new in this recession is the way policymakers have decided to respond. And one of the things they've done is they've been using a new tool, something we're going to call in this presentation Business Credit Support Programs, or BCSPs for short. These programs, what they do is they involve lending directly to firms, specifically for the purposes of fighting the recession. In the US, there have been 3 main BCSPs. 2 of them were implemented by the Fed and 1 by Treasury. So I don't have time to describe them in detail, unfortunately, but I'll only mention that both the Fed programs basically consist in the central bank buying debt from or making loans to US businesses. The Treasury program, the PPP, has received a lot of attention, but is somewhat different. It's a combination of loans and mostly grants. So our goal in this paper is to study what the impact of these programs might be and how to design them. So we're going to ask 2 more specific questions. The first question is, taking the programs as they are designed, what are their effects likely to be on participating firms? So the short-run goal of these programs is to ease financial conditions for businesses and to help avoid excess liquidation for firms that have trouble rolling over debt in particular. But achieving this sort of goal might involve some trade-offs. The trade-off we're going to be interested in this paper is the one that's generated by debt overhang. So lending to firms via BCSPs might save them from liquidation in the short run, but it'll also increase their debt burden. And in turn, higher leverage might lead to depressed investment during recovery, which policymakers might be concerned about. So we think debt overhang is generally relevant for the design of these programs, as debt so far has been the security of choice for implementing them. And we think debt overhang is particularly relevant in the current recession because leverage in the corporate sector was quite elevated coming into it. Our second question is normative, and it's how should these programs be designed? In particular, should they rely on debt securities or should they use something else? For instance, could equity injections work better? Germany tried this. Or maybe loan forbearance would be better, like the mortgage modification programs. To study these 2 questions in this paper, we're going to develop a model of investment and financing with heterogeneous firms. And then we'll use the model to think through what BCSPs could achieve when there's a crisis. We're going to model that crisis as an exogenous aggregate shock that temporarily lowers all firms' revenue and potentially exposes at least some of them to default. So our results are going to be structured around 2 different scenarios within the model. The first scenario is that during the crisis, private capital markets in the model continue to function normally. So under that scenario, BCSPs are going to act a bit like supplement to private capital markets. They're going to just generate more demand for corporate debt. And in that scenario, our result is that at best, BCSPs don't do anything, and at worst, they depress corporate investments. In particular, investment will be depressed if interest rates on BCSP loans are lower than those required by private capital markets to lend. And that result is the manifestation of debt overhang. Firms are going to take on more cheap debt from the BCSPs and end up investing less. And so optimal policy in this first scenario is just to do nothing. No BCSPs are better. Our second scenario assumes that funding from capital markets is unavailable or it is very expensive in the early stages of the crisis. And in that scenario, BCSPs will act a bit like substitutes for unavailable private capital. So in that scenario, contrary to the first one, BCSPs are actually addressing a friction, which is the temporary heightened cost of external finance. And so there, what we find is that there's large short-term gains from BCSPs. And the reason is that they help avoid liquidations that would not have occurred had capital markets been functioning normally, but which end up generating large deadweight losses. Now, the BCSPs are still going to have a debt overhang effect because they're going to force firms that participate to take on more debt than they would otherwise have. However, we find that this debt overhang effect is quite small quantitatively, and there's two reasons for this. First of all, the increase in leverage implied by the programs turns out to be quite small. And second, most firms in the model operate in a part of the state space where investment is relatively insensitive to leverage. And we think the latter point is reasonable quantitatively because we try to calibrate the model to match estimates of the sensitivity of investment to leverage obtained from data from non-public financial firms. So in that second scenario, the normative implications are pretty simple. There's no really big gains from alternative designs relative to just loans. This is simply because these alternative designs would only improve things in the model by lowering that overhang, which is kind of small to begin with. Okay, so the plan is I'll spend the next 5 minutes going over the model and how we relate it to the data, and then I'll spend the rest of the talk on what BCSPs do in the model. So let's start with the model. Here's an overview with words. At the firm level, there's two pieces to the model. The first is a standard neoclassical investment model. The second is a trade-off theory model, standard one, except that we allow for firms to dynamically adjust leverage. So firms are going to choose leverage in order to trade off deadweight losses in default against the tax benefits of debt. What we do then is we aggregate these firms into an industry in which risk-neutral lenders provide capital at the fixed discount rate R. And then when aggregated, the individual firm decisions are going to generate a balanced growth path for the industry, but there's still going to be heterogeneity, which is driven by different histories of idiosyncratic shocks at the firm level. So here's some more concrete elements for the model. The capital stock for a particular firm is a geometric Brownian motion with drift G. So G is the net investment rate. The shocks Z in green here are idiosyncratic, firm specific. And there's a convex function phi that translates net investment rates into gross investment rates. And the phi is going to capture convex adjustment costs, as well as depreciation. Debt is issued at rate iota and amortizes at rate m. And then dividends per unit of capital are pi t, and they're the sum of the proceeds from operations, the proceeds from debt issuance, and minus taxes from which coupon payments, which are kappa times pt here, are deductible. So dividends can be negative, and we're going to interpret that as equity issuance. Now note the parameter AT here, it's highlighted in red. This is the average product of capital. It's common across firms. And later on, that's what we're going to shock to generate our prices. Finally, the equity value is the maximizing PV of dividends, and the price of a unit of par value of debt, dt, is the present value of coupon payments. Note in these two expressions that we assume that there is no recovery in default, which is what we're going to maintain throughout. So the model has a sufficient state variable, which is book leverage. We're going to denote it by X. Little et denotes the equity value per unit of capital. And so there are three key first order conditions in this model. The first is the standard smooth pacing condition. The slope of E with respect to leverage must be 0 at the default boundary bar, X bar. The second is your standard Q theory condition, which says that the marginal cost of investment is equal to the marginal value of a unit of capital. Now, because marginal Q decreases with leverage in this model, this first order condition implies that there's debt overhang. So to see this, here's the investment policy function. So the X-axis here is leverage. We scale as debt to EBITDA to have more familiar units. The red line is the default boundary, and the blue line shows the gross investment rate in the model as a function of leverage. So investment is a declining function of leverage, and it's always strictly smaller than the green line. The green line is the policy function that a firm that never takes on any debt would choose. So a firm with no debt overhang would choose the green line as the investment rate. Okay, so finally, the debt issuance rate is pinned down by the following first order condition. Roughly, that condition says that issuance is increasing with the tax shield, which is the numerator in this expression, and decreasing with the slope of the debt price function, which is the denominator in this expression. Here's what the implied financing policies look like. The left panel shows the debt issuance rate. So low leverage firms in this model issue lots of debt. Higher leverage firms do not, because the return to issuing more debt tends to accrue to which is in part higher investment, tends to accrue to debt holders, not shareholders. And then the right panel shows the dividend issuance rate. So low leverage firms in the model issue debt in order to pay out dividends, so large positive dividend issuance rates for low leverage firms. And then high leverage firms, on the other hand, actively use equity markets as a sort of financing, and that's why they have negative dividend issuance rates. We then aggregate these firm level decisions. So for this, we're going to focus on a special object in the model, which is the density of firms across levels of leverage weighted by their fraction of the total capital stock. This density satisfies a Kolmogorov-Forward equation. The KF equation depends on also the aggregate growth and the aggregate default rate in the economy, and themselves, these are functions of the density, so we have to solve for a fixed point in these three objects. When we do that, here's the picture we get. The blue line is the same investment policy functions that I showed you before. The gray shaded area is the weighted density of firms across levels of leverage. So the thing to remember about this graph is that most firms in this model live in a relatively narrow region of leverage between something like 2 and 4. Okay, so I want to spend a couple of minutes talking about how we relate the model to the data. So the model has 7 parameters. We're going to calibrate 4 of them. The interest rate and the coupon rate, we're going to constrain those two to be equal. The depreciation rate, the corporate income tax rate, and the amortization rate for debt, which we set so that average debt maturity is 10 years. We're then going to estimate the 3 remaining parameters, which are the average product of capital, the volatility of idiosyncratic shocks, and the curvature of the investment adjustment cost function. So to do that, we're going to use a very simple GMM approach. That our data is going to be the sample of non-financial counter-stat firms in 2019. So we're only using cross-sectional moments. The 3 moments we're targeting in our baseline are the average investment rate, the average ratio of debt to EBITDA, and importantly, the slope of investment with respect to debt to EBITDA or leverage. So on this last moment, let me just say a word about magnitudes because it helps understand how strong debt overhang is in our calibration. So the value minus 3.66 you see at the bottom is a sort of marginal effect of debt overhang on investment. So the magnitude of this coefficient says that if you increase debt to EBITDA by 1, by which I'm going from 3 to 4, the gross investment rate at the average firm would fall by about 3.66%, by which I mean from 12% to about 8%. This is, a big shift in leverage in this model could depress investment quite a bit. But of course, keep in mind that this is a sort of average of the slope of the investment policy function across firms with heterogeneous leverage. Another way to think about the strength of debt overhang in this model is to look at what would happen if you removed it altogether. So if you look at just an all equity firm that never borrows, it grows at 3% per year, but the aggregate growth rate in this calibration is about 1% per year. So debt overhang lowers overall growth by about 2%. So going back to the 3 moments we target, our basic approach is exactly identified. The model fits those well, and it also fits well some other untargeted first moments like the interest coverage ratio, the dividend issuance rate, and the debt issuance rate. Now, we want to be clear about where the model fails, and it's in the higher moments. So the cross-sectional dispersion in leverage is higher in the data than in our calibration. Basically, the data has both more very low leverage and very high leverage firms than the model. So the model fails a bit there. But overall, the thing I want you to keep from this is that we ask the model to match the cross-sectional sensitivity of investment with respect to leverage, and it does well on fitting other for several first moments. Okay, so now I'm going to move on and tell you about what BCSPs do during a crisis in this model. So I'm going to start from a case where the crisis itself is only real in the sense that private market financing continues to be available to firms. This is going to be the case in which BCSPs act as a supplement to private capital markets. So first of all, here's what the real side of the crisis looks like. We're going to look at an MIT shock where, starting from the steady state, the average product of capital for all firms drops by 25% for 6 months and then progressively recovers. The blue line on this graph, on this next graph, is the response of the aggregate capital stock. The dotted line is the trajectory that it would have in the balanced growth path without shock. So there's 2 things to note. First, there's a small but visible drop in the stock of capital at time 0. So this is due to the fact that the shock makes a few very highly levered firms exit and thus destroys their capital stock. The second thing is that investment is somewhat slower during the first 6 months of this crisis, as you can see from the slope the growth rate of the capital stock. However, once productivity starts recovering, investment goes back to normal and capital grows the same as in the balanced growth path. Now, recall that the assumption here is that financial markets are functioning normally throughout. So what happens in the background is that firms use equity markets to smooth out revenue during the crisis. So this plot shows dividend payments during the crisis. The fact that they go negative indicates that the average firm is issuing equity as a way to maintain its capital stock and avoid default. Okay, so in the context of well-functioning capital markets, what could BCSPs achieve? Since this is, a corporate finance paper in part, we have to start from an irrelevance result. So here's the irrelevance result. Suppose that along the perfect foresight response path, the government offers funding, and crucially that the price of this funding is obtained using the same discount rate as private investors, then nothing changes. So the program has just no effect. An interesting thing about this result is it's quite general. The program can be just anything, any security, equity, hybrids, not just debt. And it can be a conditional program, an unconditional program. Either way, it has no effect. So remember, in the introduction, I mentioned that these interventions could actually be distortionary. So when is this the case? So imagine that what happens is that the BCSP is offering loans, but they're priced using a discount rate R tilde that is lower than the markets by some wedge alpha. Then our result is that relative to the laissez-faire equilibrium, debt issuance is strictly higher and aggregate growth and investment are strictly lower along the response path. So what happens? The first order condition for debt issuance when there is an intervention of BCSP is similar to the baseline one, except that there is now another term that appears as a benefit of debt issuance in the numerator. So this term is proportional to the wedge alpha. So the way to think about this is firms are issuing more debt in order to take advantage of the gap between their equity holders' discount rate and the government's discount rate. So this is going to increase debt issuance, and it's going to shift the leverage equilibrium distribution to the right. And then higher leverage is going to make investment decline. So here's what happens in pictures. The blue line is the laissez-faire response. The yellow line is the response with the BCSP. So aggregate leverage goes up during the recession. And then as a result, aggregate investment is in general lower with the BCSP than with in the laissez-faire, and lower investment persists for a while because firms have to work through their overborrowing generated by the BCSP. Okay, so the general message for the first scenario is BCSPs are kind of a bad idea. They just depress investment. Okay, so now let's look at a different scenario in which private capital markets are disrupted during the early stages of the crisis and BCSPs might be implemented. So the way we're going to model this disruption is as a total shutdown of debt and equity markets for the first 6 months of the crisis. This is obviously somewhat extreme, but it helps illustrate the implications of the model. With closed debt and equity markets, dividends must remain positive during the crisis, and there can be no debt issuance. And then firms are essentially liquidity constrained. So there's a static upper bound on the investment rate. So firms are not going to be able to invest more than allowed by their net income. And because the investment cost function has a global minimum, the liquidity constraint can also trigger liquidity defaults. Okay, so broadly speaking, think of this capital market shutdown as imposing a sharp liquidity constraint on firms for the first 6 months. So here's what this generates when there's no intervention.
Niels, just wanted to give you a 5-minute warning. You have
Thank you, Niels. Yeah, I think this should be good. So this is what happens with when funding markets are not functioning normally during the crisis, but there is no government program, so no BCSPs. So the blue line is the aggregate response path that I showed you before when funding markets are functioning normally. The orange line is the disrupted funding market scenario. So two things I want you to note here. First, there's a big discrete jump downward in the capital stock at time 0. So this is the wave of liquidity defaults, and it's concentrated in the model among firms with high leverage. Second, investment is depressed for the first 6 months. So this is again the effect of the liquidity constraint. Surviving firms can only invest up to what their net income allows for. And so then when markets reopen at month 6, investment resumes at a relatively normal pace. This is what aggregate investment looks like. So what you can see is in this scenario, investment drops all the way down to 4% per year instead of only dropping to 8% during in the first scenario. And then it recovers as soon as markets reopen at month 6. Okay, so what I'm going to spend the rest of the talk thinking about is what can BCSPs do here. So the first intervention we're going to consider is the following. This is the one that's closest to what's been done. The government is going to provide funds to firms in exchange for debt claims. We are going to assume that these debt claims are priced at par. we're going to allow these firms to use the program up to the point where their EBITDA plus the proceeds from the program are equal to their pre-crisis EBITDA. So note that this program, the debt on this program is not fairly priced. So there's going to be an implicit transfer from the government to firms here, a fiscal cost to the program. So if you do this, here's what you get. The green line in this graph shows the effect of the program relative to the laissez-faire equilibrium. There's two things that are different. First, the initial drop in the stock of capital is smaller. This is because the program avoids the initial wave of liquidity defaults. And then the investment during the first 6 months of the crisis is less depressed. And this is because the program allows surviving firms to invest more than their net income. So you can see the latter point a bit better on this graph. The aggregate investment rate during the crisis only drops to about 8% per year instead of 4% per year without the BCSP. Now, if you look at the behavior of aggregate investment after the crisis, so after month 6, what you see is that the green line is lower than the orange line. And the gap between these two lines can be thought of as the effect of the debt overhang generated by the program. The gap is there because more highly levered firms survived the crisis because of the BCSPs. So those firms have lower investment rates when the recovery starts, but as you can see, just eyeballing this, the quantitative effect here is quite small. So here's some simple heuristics to understand why that effect is small. Initially in this model, the debt to EBITDA ratio is about 2.7. You can ballpark the increase in the ratio that the BCSP is going to generate. So it's going to be proportional to the ratio of EBITDA replaced by the program, which is the size of the shock, so 25% of the initial value of A, multiplied by the duration of the program, which is 1/2 or 6 months. So that gives you an increase of debt to EBITDA in the order of 0.12. And so the debt to EBITDA ratio will move from something like 2.7 to 2.8. So now if you plot this against the investment policy function, which is what I've done on the left panel, you can see that this is not a big shift. Okay, so this is a small shift, and it also happens in a portion of the state space where the investment rate is just not super sensitive to leverage. And so the overall effect on investment is small. So let me conclude by talking about alternative program designs. Here's what you obtain if you do loan forbearance on existing loans instead of giving firms new loans. The effect is quantitatively similar. There's just slightly less debt overhang in the recovery. And here's what an equity injection program does. So what we do here is we size up the price of equity issuances bought by the government so that the program has the same overall fiscal cost as the subsidized loan program. So the two are really comparable. And as you can see, the program has quantitatively comparable effects to the loan-based BCSPs. There's just a little bit faster of a recovery. Okay, so I'm going to stop here. Question 1 was, what are the effects of BCSPs on firms' decisions? We answered that 2 ways. We think they'll depress investment if all they do is add demand for corporate debt, subsidize demand to corporate debt to already well-functioning capital markets. But if they act as substitutes for private capital markets, there's going to be a net positive effect on aggregate investment, despite their bad effects on investment through debt overhang in the long run. Our second question was whether there would be gains from designing these programs differently, and here our answer doesn't seem so, unless in reality the swap of investment to leverage is somehow much bigger than what we calibrated the model to. Okay, so there's obviously a lot more to do here, so we really look forward to everyone's comments.
Great, thank you very much. We have Toni Whited as discussant. Toni, can you please share your screen?
Yep, here we go. And how's it working?
Looks good.
Can people see my? Okay, we're in business. Let's start. Yep. I'm timing myself, so you don't have to worry about that. So thank you very much for inviting me to discuss this paper. It is obviously right up my line, and I think it's asking a really interesting question given the current state of affairs in the world. So let me get started. Do credit support programs help firms? Like I already said, this really is an incredibly important question. And the answer is, well, it depends. And the depends part is actually quite interesting. So if government credit carries the same rate as private credit, there's kind of an MM-like result in the model where it doesn't really matter. The next result that I thought was interesting was if government credit is cheaper than private credit, if it's subsidized, then these programs are long run detrimental. And so this is where the debt overhang comes in. So too much uptake leads to debt overhang. And so even though they might have a short run positive effect, in the long run, they depress investment. And credit interventions, either subsidized or not subsidized, can help if other financial markets freeze at the same time as the TFP shock that they look at. Okay, so if you want to get something out of this paper, that's the answer. So I want to talk about three things. I want to review the intuition in the model because I think that's going to be important for talking about the next two things, which is I want to think about whether the quantitative results make sense. I want to stress right now that the qualitative results make a lot of sense, but I want to talk about the quantitative results because I think that this is certainly important for getting policy recommendations right. And then I want to talk a little about, is this the right model? And that's also very closely related to whether the quantitative results make sense or not. So the analytic framework for this question is very standard. So it's an infinite horizon, partial equilibrium model of a firm, well, a bunch of heterogeneous firms with respect to one little shock. There's a little bit of welfare at the end, but mostly it's analysis of firms. And given the question at hand, I think that's the perfect framework. So the firm makes simultaneous decisions about investment, there's adjustment costs, and then long-term tax benefited unsecured debt. And because debt is unsecured, the firm can default. So I think this is a quite nice setting for analyzing policies to alleviate negative shocks. Okay. So they've got one thing that the authors stress a lot is that and they actually apologize for it a lot, is they have a constant returns economy and they say, oh, we know this is not perfectly realistic, but it makes the model easier to solve, blah, blah, blah. But I actually think it's good, and here's why. So they've got this constant returns economy with investment adjustment costs and long-term debt. And actually, we already have some really nice intuition about this kind of an economy from Christopher Hennessy's old job market paper. The following intuition is from the Hennessy paper. It's not quite right in the current paper, but it's very, very, very close. So in the Hennessy paper, investment is determined solely by marginal Q. Marginal Q equals observable average Q minus a debt overhang correction. And then this is the part that I think is useful because overhang, the intuition behind overhang in a dynamic model is a little bit different from the intuition behind overhang in the old Miller framework, which was just about the proceeds from investment accruing to debt holders. Something else happens in a dynamic framework, which is that overhang lowers marginal Q because it truncates equity horizon at default, just whacks it off. And so that is quantitatively a bigger way whereby overhang affects investment. I actually think this model is better than a decreasing returns model. And so why is that? It's non-stationary. They're constant returns to scale. The optimal capital stock is undefined. And in this non-stationary environment, average investment just is a function of marginal Q. And so you get these value effects directly affecting investment. And if you're interested in investment, that's a nice way to go. Decreasing returns models have the unfortunate property that they are really just models of deviation from trend. And so unless you mess around with third moments, it's really hard to get average investment to deviate from the depreciation rate. And so I think that actually they've picked a rather framework that is both mathematically convenient and appropriate. So good. More intuition. Here are the costs and benefits from financing with debt. Debt is long-term, which I think is appropriate. There's a standard dialed-in tax benefit of debt, which is appropriate. Equity issuance is costless. And so and equity issuance in the model, as you have seen, is just negative dividends. So what that means is that if the firm runs negative profits, equity holders reach into their very deep pockets and just make up the difference for the firm. Okay. The firm can finance old debt with new debt, debt's unsecured, and default is a value default condition. So default occurs if debt gets so high that equity value falls to zero, and then all capital goes up in smoke. The authors complain about that. That's probably not that big a deal for their results. I've played around with these models a lot, and the recovery rates tend to matter, but they're not, the quantitative effects are not big. What matters is the positioning of the default threshold, not what happens in default. Okay. So here's the important thing about the costless equity issuance. In this kind of a model, a firm is going to use a lot of leverage, because even if they have a ton of debt, they're going to finance that debt. They can roll that debt over with costless equity issuance. And so they can just edge right up to that default threshold and stay very close. Why would they do that? Because they want to eat up the tax benefits of debt. Okay, so that's the thing to keep in mind as I go forward, is in this model, you're going to have a lot of firms glued up or up against that default threshold, or at least very, very close. So what's the policy for experiment? First, uncertainty in the model is actually not shocks to TFP, it's just these IID shocks to capital. And so a shock is just this MIT shock. It's a one-time parametric drop in TFP that just recovers linearly with perfect foresight. So here are the results again. Government credit is priced correctly. Firms' first order conditions kind of don't change. There's a little bit of something going on, but not much. If credit is cheap, remember in these models, debt's really just a storage technology. And if you offer a lower rate on an almost linear storage technology, a firm's going to eat it up. And so they use up too much debt, and then overhang depresses long-run investment. If there's a simultaneous credit freeze, remember in this model, you have all these firms backed up against the default threshold. So when you give them an adverse TFP shock, they start to hurt. And that's why having an intervention with the simultaneous credit freeze helps a lot. So companies avoid default by refinancing, and so this credit freeze can be very bad. So that's where the interventions are very useful. Okay, let's do this. So I didn't understand the calibration, but the calibration changed since the version of the paper they sent me. So I'm going to be thinking on my feet a little bit here. Here we go. First, I thought, so they calibrate leverage to CompuStat debt to EBITDA. And I thought, that's strange, because EBITDA for the last 10 years has been negative for about 25% of CompuStat firms. So I don't know quite what they did with that. And the negative EBITDA firms are about 50 times 50. That's not a typo, even though I make lots of typos, times smaller than the rest of the sample. And these negative EBITDA firms have very low leverage. So I wasn't quite sure what was going on there, but it sort of doesn't matter, because I was trying to fit, they have this debt to EBITDA ratio of 2.7, and I thought, gosh, that doesn't make sense to me. That's too big. What's going on? And it turns out they're using gross debt to EBITDA on their calculations. And here's the problem with that. Their model doesn't have cash. And because their model doesn't have cash, their state variable, their storage technology, is really just net debt. And if you wanted to think about the right economic concept in the data, it's net debt. So and on an intuitive level, what matters for firm behavior is net debt. So actually, compared to net debt to assets, model leverage is way high. So net debt to assets in the US right now is like way less than 20%. It's about 15%. And in their model, it's about 70%. So they've got this huge difference in leverage ratios. Now, if the calibration matched net debt to assets, the MM result would not change. The MM result's the MM result. But the subsidized credit result would certainly not change qualitatively. The economic intuition there is sound and right, but it might get magnified, and here's why. So what if they actually somehow, I think it would be hard, manage to match net debt to assets in CompuStat data. And you'd have all these firms that were way far away from the default threshold. You give them a subsidy on a linear storage technology, they're going to get very excited and go way up to the edge. And so the change in debt overhang actually might be quite large, because you would have these conservative firms, you give them a subsidy and they go nuts. And so you would have a bigger change in debt overhang. I think the credit freeze results would be less dramatic. So if you actually tried to match net debt to assets, then there would be firms that would be way far away from the default threshold. And so there would be fewer initial defaults, and maybe these credit programs would not be quite as beneficial in dealing with these defaults because there wouldn't be as many defaults. I have one thing to say about the calibration of the sensitivity of investment to debt to EBITDA. So this was not in the version of the paper that I saw, but in the dependent variable, you have investment, and in the independent variable, you have debt to EBITDA. EBITDA is in the numerator, EBITDA is in the denominator, investments in the numerator. Those two things are robustly positively correlated in CompuStat. And so that might generate a mechanical negative correlation that you might want to worry about. Okay. Well, if I were writing the model, I wouldn't add state variables or ask the authors to do anything that's impossible, because I myself am sick of people asking me to add state variables to my models, because it's just a pain. So I would just ask for a couple of tweaks that would not make it that difficult. So it's got to be really hard to get this model to match actual leverage, like debt to assets, because there are no equity issuance costs. And that's one of the big differences with the old paper that I did with Christopher Hennessy. So, but why is that important? And what does that mean for firm behavior? Like I said, in the author's model, it's optimal to get really close to the default threshold, and their debt to assets ratios must be around about 70%, which is not what's happening in the US, except for maybe Delta Airlines. So, and why is that? It's always possible to repay debt by floating equity. So the model fails to match some features of the data. I talked about leverage, but also it fails to match equity issuance. So there's this wonderful old fact paper by D'Angelo and Stultz. Equity issuance is very rare in the US, at least the part that's unrelated to option exercise. Issuance occurs more often in low leverage, high value firms. And in this model, it occurs in high leverage, low value firms. And so the equity issuance, although the authors say that kind of resembles what's going on with zombie firms, I think it's actually counterfactual to what's in the data. Easy to fix. Add an equity issuance cost. Okay, so you might lose a little homogeneity, and it might take a few extra seconds to solve the model, but it's not that big a deal, because it has this huge benefit. It adds a precautionary motive to the model, and this firm would stay away from the default boundary because they would be avoiding that costly equity issuance. And then you would be able to get leverage ratios that were much more in line with the data. And it wouldn't take much. Small equity issuance costs, like remember the old menu cost issue literature? They really dampen equity issuance. So I think having lower baseline debt would imply qualitatively very large differences. The other thing I think that would be interesting to add to the paper that I don't think would be particularly hard, especially since they're thinking about MIT shocks, which are not hard to model. The credit programs didn't happen in isolation. So the other thing that happened is the federal funds rate went to from 2-ish% to 0, boom. And the Fed pumped an enormous amount of liquidity in the markets, and many people have hypothesized that that's one of the things that's buoying high stock prices. And so I think it would be interesting to look at a joint experiment in which you dropped interest rates, which would increase firm value, lower defaults, and have the injections at the same time, because I think that would be much more in line with what we've actually seen in history. It's great. March is history. The world is moving so fast. And I think I'm going to finish about a minute early. So I like this paper. This was a neat paper. This was a fun paper to discuss because it's actually a good paper. I hate discussing bad papers because you have to be nice when you don't feel like being nice. This is an actual good paper. I think that the basic analytical framework is the right one. The question is super interesting. I just think they need to get the quantities right, because I think good policy answers require realistic quantitative predictions. So maybe a slightly different model, just add some equity issuance costs would be the right way to go, and be a little bit more careful about getting leverage right. And that should be easy. And then I think even if the policy implications were different, it wouldn't matter, because they would be what they would be, and they would, no matter what they were, they'd be interesting. So once again, thanks for asking me to discuss the paper. I liked it a lot.
Great, thank you very much, Toni. Nick and Fabrice, do you want to take a few minutes to respond to Toni?
Yeah, I'm Niels. Yeah, thanks. I'll take a first kind of set of comments that Toni went through, and I think Nico will address a few others, in particular on the estimation and the CompuStat data we're using. First of all, Toni, thank you very much for this discussion. Let me try to address a handful of comments that you're making. Some, are a point on, in particular, the question of counterfactual equity issuances for high leverage firms. This is unfortunately a standard issue with the class of Leland models, where we're basically always in a situation where shareholders end up with negative cash flows just before defaulting. We could introduce, sort of issuance costs proportional to equity issuances. It would still be in a situation where shareholders optimally default just at the time where they're still incurring negative cash flows. In other words, at the point where they're still injecting cash into the firm. That's kind of related also to another point you're making, which is this idea that firms near the default boundary are clustered there. I think, if you look at the station, so we have a model with idiosyncratic shocks to capital quality. So if you look at our stationary leverage distribution, actually it's quite the opposite. There's a density equal to 0 of firms exactly at the default boundary. And if you look at the distribution, it's actually there's a very small mass of firms at high debt to EBITDA ratios. Now, what happens is, in the experiment where we have this kind of a pandemic shock and we shut down credit markets, effectively firms are incapable at that point to issue equity. They're incapable of issuing debt. And so that creates a large point mass of firms that default at the time of the pandemic shock. But at least if you look at the stationary leverage distribution, there's effectively a density equal to 0 of firms exactly at the default boundary. In terms of the point you're making about gross debt versus net debt, I think that's a completely valid point. The way we only have one state variable in the model. We don't have cash. We don't have liquidity lines in the model. We don't have any reason for precautionary savings motive for the firm. And so it's probably right to interpret our debt in the model as net debt as opposed to gross debt. So I think that's a very valid point. Of course, if we were adding sort of cost of issuing debt or cost of issuing equity, there would be scope for a second state variable, which would be cash, and so we would have like effectively something more meaningful to say about cash holdings and so that could potentially address some of the points you're making about again sort of counterfactual equity issuances near the default boundary. In terms of, I'm just trying to sort of go through the list. Yeah, the last thing that you sort of raised at some point was kind of again our assumption as to what happens at default in terms of creditors losing effectively everything at that point. I mean, it's kind of a technical assumption. Yeah,
that's fine.
I mean, Yeah,
that's not I don't think that's a big deal. I think it might make a referee's, like, the hair on their arm stand up, but I don't think it's a big deal.
I mean, I agree with you. And so there are ways to salvage this, which we can talk about separately. But I agree with you. I don't think this is a huge deal. Yeah. And and I think, Nico, you probably want to address some of the points that Toni makes on some of our estimation, because again, you're.
Sure. I mean, very quickly. First of all, Toni, thanks a lot for a great discussion. I mean, your point about leverage being too high in the model's current calibration, I think, is totally reasonable. If we should probably target net leverage, not gross leverage, as you suggested. Just briefly on the debt to EBITDA calculations, the reason we did it was simply, we used debt to EBITDA was simply because so totally obvious what the K in the model is. So in the data, so that, whereas the AK is debt to EBITDA in the model, and that's quite clearly defined. We truncated firms that had negative debt to EBITDA in the data for that reason. So that's potentially a problem.
Okay, so that makes sense.
Yeah.
You know what?
Yeah.
I did the same thing and I got 2.7. So yeah.
Yeah. So, but I mean, those comments are very well taken, and we'll, this is a matter of adjusting, I think, the moments we're targeting, and thanks a lot for raising those points. I guess the only, yes, you had a question about the moment we're targeting. Sorry for not forwarding you the new calibration. We're targeting a slope between investment and debt to EBITDA. We've also looked at slopes between investment and book leverage. Those are negative in the cross section we're using, so that's a different way that we could maybe less mechanically try to match that moment that we think is important. The last thing I was just going to add is, just as Fabrice said, this model has firms that operate at fairly far away from the default boundaries, and it's in part why we find relatively low debt overhang effects. So the mass of firms is really concentrated in the middle. So maybe some of the intuitions you were suggesting, I don't know if they're going to work out even if we add equity issuance costs, but we could definitely look into that. But again, thanks. That was a really useful discussion.
So I just wanted to talk a little bit about, you have to understand where I come from. I solve these discrete time models, and where it's really hard to solve for the default boundary. When I said bunched up against, I didn't mean that they were literally against. I just said that they were closer than they would be otherwise. Otherwise, you wouldn't have such enormously high leverage in the model. Like 0.7 debt to assets is tough. By the way, the reason why EBITDA is negative for a lot of firms, it's not obvious what capital is in the model, and they expense intangibles, and then that turns it negative. So it's not clear what the right thing to do is. Anything else? Oh yeah, take a look at Hennessy's paper. He's got empirical work. He's got a debt overhang correction. You might want to match that, because it's almost exactly identical to what you've got in your model. And that's it.
Great.
We'll look at that.
Thank you very much, everybody. Then let's open up for some questions from the audience. If you have any questions, please just use the raise your hand button, and we will we'll take some of the questions that comes. Right now, we can see Laura Welcome has a question. If we can unmute Laura.
You hear me? Good. So I interpret this paper as saying that when the government provides credit, it doesn't increase the financial value of the firm. But I'm afraid that it's pitched as, or might be interpreted as, providing credit is bad policy. So why do I think there's a difference between the two? Because if I think about why were a bunch of these policies enacted? The reason has mostly to do, I think, with labor markets, and that preventing bankruptcy or preventing firms from being scaled back could prevent job separations. It could take years to repair. Now, I don't want to commit Toni's sin of asking you to put more state variables. That's not what your paper is about. But I want to ask, is it a fair conclusion or interpretation of your paper to say, if you want to issue government credit, do it for the labor market externalities, but don't do it for the benefit of the financial asset holders? Or am I missing something?
Should I start now, or should we take more questions? Niels, what do you want to do?
Let's just take one question at a time. So please answer right away.
Yeah, Laura. No, so Laura, first, you're absolutely right that we're completely ignoring any sort of labor market action, if you will. don't misinterpret our paper. Our paper says that credit market interventions are really important as soon as capital markets are not functioning super smoothly, right? So our kind of Muddy-Miller type result is really in this idealistic environment where, you know, credit and equity markets are perfectly fine. As of today, yes, for large investment grade firms, equity and credit markets are open. For anybody else, you know, credit markets are closed. You know, for like small businesses, you know, medium-sized businesses, we know that bank lending standards have tightened significantly. And so I think our paper is not saying that these interventions are not useful. We're saying they're very useful in case where, you know, there are sort of credit market issues. If we're adding above and beyond this issues related to labor markets and labor market frictions and, you know, unemployment that would have sort of welfare costs, I mean, this would add on to the benefit side of the ledger without including any additional costs. And so I think, you know, that's kind of the way I'm thinking about the paper.
Yeah, I would just add to Fabrice's answer. The supplemental message of the paper is if you're implementing those policies, maybe don't worry. So as you said, do it for labor market externalities, and also don't worry too much about debt overhang. That's the other thing that comes out of the model. It doesn't seem to be a huge thing quantitatively, subject to Tony's comments on quantification.
Great. We have time for one more question from Yao Singh. Yeah, can you unmute your? Yeah, perfect.
All right, thanks. Yeah, I think it's very interesting to think about the debt overhang aspect of government intervention. But I also think there is a related and alternative notion of debt overhang potentially coming from those largest companies heavily drawing down their credit lines even before the government interventions came into play, right? Typically, we don't think of, debt overhang when we think about credit lines, but if you think about the very largest companies, their credit lines are actually pretty long-term, typically more than 1 year or even can last for several years. So I wonder if you can also potentially talk about that notion of debt overhang or potentially distinguish between those two.
I actually missed that point. You're talking about so large firms having drawn their credit lines at the beginning of the COVID crisis. And
yes, even before the credit programs introduced by the government. And I think that could potentially lead to a different notion of debt overhang, right? Because at some point you still have to pay back those credit lines, even if we don't typically think of,
I think again, there has been some work in that space. I think the evidence is that a lot of investment grade firms drew on their lines of credits and just they parked their cash at the bank. And so in the end of the day, if you interpret our model as net debt, you could basically see through the lens of our model as firms having drawn on their credit lines and just, park that cash, at the bank, which extended those lines of credits. And nothing really happens. I guess the question would be if those firms truly use that cash they obtain from their lines of credits for other reasons, let's say for paying dividends, for example, but I don't think that's kind of really what happened. And I guess
you want to double check. So I'm not sure if they actually just park the money in their bank deposit account, but I'm not exactly sure about number, but I think it would be nice if we could double check that, whether they use that to,
I don't know if there's data on what they did with the proceeds from these credit draws.
Okay, great. Nick has a very quick comment. Is that right, Nick?
Oh, no, I was just, maybe to Ya's question, I was just going to add that.
I meant the other Nick, sorry.
That's all right, but if Nico wanted to say something, that's fine too. He's a presenter. No, I had a thought about Tony's comment about sort of the counterfactual features of the model, right? The inequity injection when the firm is in distress and equity and leverage is large, and also you guys get the leverage on average being a bit too high. That certainly applies to the kind of our usual sample of public CompuStat firms, right? But if we're looking at the rest of the economy, to which these policies have also been targeted, and privately held firms in particular, I'm not so sure that the leverage is too high. For example, privately held firms are a lot more highly levered than publicly held firms, I think. Well, Tony, you may correct me in a second if you think I'm wrong. But if the privately held firms held by private equity firms, in fact, and private equity funds do make equity injections a lot more than we see in public firms. On the other hand, of course, the whole issue of debt overhang then also kind of becomes less powerful, because the private equity firms typically hold both debt and equity, and they mitigate debt overhang by doing so. So I don't know how you guys think about to which part of the economy this is supposed to apply. Is it supposed to apply to everybody? Is it really a model of kind of publicly held firms that have access to public equity markets that may or may not freeze up in these times also, by the way? Or are we talking about the rest of the economy?
So I know it turns out that at least the private firms in the Federal Reserve's Y14 data are only slightly more highly leveraged than the public firms.
Well, we can have a separate conversation about that.
Yeah.
But I think that is a trick.
Yeah, I would
measure their leverage because of how it's recorded on their books. But
I've worked on, so just back agreeing with Toni here, but on different census data that has information on financing of smaller private firms, and there isn't that much variation in leverage either there. So I mean, PE might be a little bit of an outlier. I think also in the point you're raising is, which firms are these programs targeting? That's a tough question, but the Fed, there's two Fed programs. One of them is clearly targeted at the corporate credit facilities, they're called, or clearly targeted at publicly traded investment grade firms. We know far less about who participated in the other program. They were meant to target smaller firms, but it's not clear that they actually reached them altogether, and it's possible that the firms that borrowed ended up being relatively large. So, given there's so much uncertainty about participation, we chose to use Compustat data to estimate our moments. But your point is fair. It might be that the firms that are participating are special in some way and have very high leverage compared to the Compustat sample.
Okay, great. Thank you, guys. Let's do a very quick 4-minute break, or more like a pause, for people to get a cup of coffee if they need, and then we'll reconvene here again at 11 o'clock Eastern time, and for the next talk. Thank you.
Hi, Niels.